Good evening. This is Ken Long from Tortoise Capital with a review of an intraday turbo trade in symbol XIV, the inverse VIX volatility ETF. This was set up on a swing trade pattern for us, and so we were keen to stalk it in the morning and look for opportunities to improve our entries for potential swing trade later. Essentially, we're going to try to swing trade one day at a time in this sideways choppy market by looking for good swing trade candidates, trying to make some money on them intraday, and then use that earned money to fund any overnight risk that we might want to take. And so, I should say this is August 12th, 2015. And so here we have the open. This was yesterday's close, and here we have the open. It's a big gap down. We have a period of sideways choppy activity here until about an hour into the session. And then you'll notice that the Bollinger Band collapse. So we're stalking what we call the Z3 pinch, which is when the Bollinger Bands period 30 plus or minus 3 collapse within less than our frog box, which is our standard unit of measure, which we compute on a daily basis. And so when it is pinched, I've highlighted that price action here in the yellow. We take the entry when price leaves our pinch box here at the green dot. We're using a 50-cent stop, essentially managing the Bollinger Band mean as the as the stop. We get an exit. So if our entry is at about 45 and a quarter with a 50-cent stop down here at 44.75 and a simple trailing stop, we end up exiting when it touches the Bollinger Band mean here at 46, almost 46.50. So that's a 2-hour trade from entry to exit in a very orderly fashion. We get a rebound and a 1, 2, 3 re-entry. The 10-period regression line leaves the dragon, which is this indicator we use here as a noise and directional filter. We get our re-entry at 46.75, again using the Bollinger Band mean as our initial stop, so that's about a 50-cent trailing stop. As we start approaching the lunchtime, price rolls over, the 10-period regression line rolls over, starts to penetrate the dragon, and so we take our orderly exit around 47 and a quarter, which gives us about 1.5 R, so about 3.5 R in the usual way using our intraday technique. So some things that we like to highlight with the blue circles. When we mark up the charts, we use blue circles to help us focus on things that we want to study later. And I would just have you notice that the swing lows of the 10-period, 30-period, 90-period, and 270-period regression lines, the moving regression lines, we see the 10, the 30 follows shortly thereafter, then the 90, the green line rolls over and starts hooking back up. The 270 is this purplish line, and then it rolls up. So there is an orderly progression of all the regression lines turning as price recovers from this large gap and then reversal day. I would also notice here that when the black line, which is the 30-period regression line, crosses over the 30-period regression line, or the 30 crosses the 90, we have a 30-90 crossover. Because we're looking at 3-minute charts, that's the equivalent of our standard 10:30 crossover on the next time frame up. So on 10-minute charts, this is about where we would get that 10:30 crossover, but when you project it down on the 3-minute charts, you get the same effect by tracking the 30 and the 90. Here is where the 30-period moving regression line crosses the Bollinger Band mean. That always indicates a healthy and improving market and the end of the downward pressure and the potential for upward pressure. When it leaves the river, we have the beginning of trending behavior up in here. So this actually gives us a little warning. So when the 30 enters the river, ready. When it crosses the Bollinger Band mean, set. When it leaves the Bollinger Band river, go. So ready, set, go. I would also like looking at when the 90 crosses the VWAP, that's the volume weighted average price. Here's where the 30 did it. 30 crosses it again. This is where the 90 crosses that VWAP, and that seems to be important. The 270 doesn't cross till much later out here. Maybe too late for us to capture the move. But all of these little green, or little blue circles, are indicators of potential Turning points, they are confirmations of improving price behavior, so we start accumulating those things as evidence. When the 90-period regression line crossed the Bollinger Band mean, we saw here's where the 30 crossed. This is where the 90 crossed that Bollinger Band mean. That made it clear that this was going to be potentially a very nice trade once we had the turning movement of the 90 and then crossing back over the river and going on. That was the final additional confirmation that we needed. I get no problem with this exit here to preserve the 2R and then immediate re-entry once price fails to fail further and the trend continues. The 10 leaves the river, or leaves the dragon, and that gives us the authority to re-enter quickly. So all in all, about 3.5R in an orderly fashion in the usual way by connecting our swing trade time frames and emphasizing that as a trading target intraday, especially effective during sideways choppy markets on daily charts like we are right now, because you quite often see large range days but no follow through. So we like to earn our risk capital intraday and then use that to fund any overnight risk if we feel so inclined. So that's today's trading lesson. Thanks a lot for listening. Keep your risk measured and your powder dry. This is Ken Long from Tortoise Capital. Good trading.